Yo guys, it's John here with Option Lab, and in this video, I'm going to be addressing one of the most common questions I get in my comments, especially recently that I posted that video that I made 931,030 days. By the way, if you guys need any proof, account statements, whatever, send me a message or pop in my Discord to get those. So anyway, the question I want to address is what is the criteria I use to pick stocks for my strategy, and more specifically, the comment that I want to address is how do I manage risk and how do I manage to not take any big losses? Because I hear people saying selling to open options is risky, it requires a lot of capital, and these are all valid concerns, and I want to address some of them in this video and kind of show you how I navigate through those waters. By the way, if you guys are interested in printing money in the background with these strategies that are mostly 70 to 80% probability, hop in my Discord. I've been talking to all of you guys one-on-one when you get in, and I've had, even just in the last week, about 3 people already hit a few $100s in a week that I've been working with one-on-one. So really happy to see that. Link is down below. Anyway. So for my $931,000 month, what are the questions and the criteria I ask myself before I sell to open a put or sell to open any option strategy? So let me shrink myself down. And if you guys are a total beginner or you're coming over from another YouTuber who draws stuff on the charts and pretends that it means anything, this is kind of what option selling is. So if you have a stock and it's going like this, if I sell to open a put, say 20 points below where the stock is, I collect a premium or money for entering that trade. And as long as the stock stays above that strike price, by expiration, I collect my premium. So how do I actually go about mitigating risk? So number one, am I willing to own the stock at this price? So if I'm selling to open a put, like I said, I'm looking at longer time frame charts, and I'm asking myself, if I were to be assigned 100 shares of this stock, if it goes below my strike price, am I long-term willing to own the stock at that price and go on to write covered calls in the option wheel, right? So the first step when I'm selling an out-of-the-money cash secured put, I ask myself, am I willing to own the stock at this price? For you guys, if you're just starting out, this is a good criteria. Next, if I'm not willing to own the stock at that price outright, should I just turn it into a spread? In other words, if the stock is here, instead of selling a naked put that requires a lot of capital and more risk, should I just take that trade but add a protective layer below? And this is great for you guys who have a smaller account. So a lot of you guys I've been working with one-on-one, I've been recommending this, and it's been working out well for you guys. So if you're not willing to own the stock, enter a spread. Third, if you do go naked, meaning if you open up a naked put or a naked call, and you're pretty sure you're not willing to own the stock at that price, but you want to take the risk and go naked because the premium is super good, is there a time frame in which I can get in and out before I incur a significant loss? So I just had a call with somebody last night, actually, and they explained this scenario, right? That the danger of the strategy is that if you have a stock that looks like this, that over time just consistently goes down, who's to say you can't get assigned, right here on a naked put, and then the stock just keeps plummeting from there, and you just continuously lose money because you got assigned the shares. So one way to combat this is using shorter expirations on the riskier stocks. So typically, if I'm doing this, I'm going based on back testing, 30 to 60 days till expiration. But if I do go naked on a stock that I'm not as confident about, or if it's a spread, I'm usually going shorter time frames because this gives it less time for the stock to move significantly against me. And if I do get assigned, like if there's a recent earnings, it usually allows me to play that short-term bounce. So, let's go into kind of another principle here that I want to explain. So if you take all of my trades as a, 100% of them, right? So this represents 100% of the trades I take with this strategy. And if I'm trading 80% probability trades, right? So that the strike prices I'm choosing for these options are 80% probability. Let's say out of 100 trades, 80 of them are winners. So the real question when you ask this about the wheel strategy is, how do you minimize the losses so they don't overweigh your wins? And the answer is, number one, going by these criterias. So for the most part, these losses, 10% of that 20% of losers, I can turn into winners. So what does that mean? So if I sell, if I'm choosing options or choosing strike prices on stocks that I'm willing to own, and they do get assigned, right? So I'm counting this as anytime I'm assigned stock on naked puts or naked calls. If I'm willing to own that stock or I'm willing to be short the stock long term, then I can write calls and end up profiting off of those calls. So that's the wheel strategy. So right here, I'm selling to open the puts. 80% of the time, that's going to win. The 20% of the time I take a quote unquote loss or I get assigned the stock, 10% of that 20%, I'm turning into winners based on when I'm assigned the shares, I'm selling an out of the money covered call, not only making the money on the premium that I get for writing those calls, but the difference between the price, the stock that I own, the difference between the price I own the stock at and the difference between the covered call strike price in which I'm losing the stock. Again, if you're new to this, this is going to be gibberish, but so let me just, briefly kind of go through again what I'm doing. I kind of repeat this in every video. I'm finding high IV stocks with news or overextension, selling 0.20 delta credit spreads. In this case, this would kind of match with this strategy. For ones that are higher IV that have juicier premium, I'm typically protecting myself and turning those into spreads, collecting the premium, or I'm wheeling the stock, and I'm managing my capital based on how confident I am that if I were to get assigned naked and get those shares, am I confident that I could implement the wheel strategy in which I actually turn an assignment into a bigger win with covered calls? And that's kind of what I explained up here. So like I said, if you guys need help on this or you want more details, shoot me a message in my Discord. I'm going to take a few more of you guys one-on-one this week in a call. Just send me a message if you're interested, and I'll see you guys in the next one.